Hello, everybody, and welcome to our weight of the evidence looking at for Q4 of 2025. So we're glad to have you all on the line today to listen to the call. A few things before we get started with all the information. There are some educational resources available for you. You can find those on the widget on the right-hand side of your screen. The other big thing is CE credits. I know a lot of you will have questions about that. If you're listening to the live version of this call, if you stay on for 50 minutes, those CE credits will accrue to you. If you're listening to the replay, there'll be a quiz at the end. You just go through, take that, and then you'll get the CE credits. As far as Q&A goes, there's a box you can submit Q&A to in the panel there. So just submit everything online. We'll try to get to as many questions as we can. We got a lot of content today, though, so we'll try to pick them out as best we can. And then finally, at the end, there's a survey that will come up. We would really appreciate you guys doing the survey. That really does help us going forward, tailor the content of these calls and things like that to what you all want to see and want to hear about going forward. So we have a great lineup today for you. Miles and I work at Dorsey Wright. I work on the portfolio management side. Miles is one of our research analysts in our Virginia office. We're going to look really at the market from a technical standpoint, what's going on with different asset classes, major indicators, things like that. Then we'll bring Phil on to talk about what's going on from an economic backdrop standpoint. And then Yanni will take a look at the markets from a more fundamental standpoint. So I think we have a nice kind of rounded out section here today, and we should get a nice view of the market from a bunch of different angles. Now, as we go through the presentation today, we're going to start with domestic equities, just kind of set the tone of where we are, where we've been, where we might be going. We'll hit on international equities, which continue to have a strong year. Touch a little bit on fixed income, which is at the bottom of our asset allocation ranks, and then go on to some of the fundamental and macro updates. For those of you who don't know a ton about Dorsey Wright, let me just kind of set the stage there. Dorsey Wright was founded a long time ago. We have an office in Richmond, Virginia. We also have an office in Pasadena, California. We really kind of have three main business lines there. So we have an asset management arm where we do separately managed accounts. If you're a financial professional, we are most likely on one of your platforms there with our SMA products, whether it's as separate accounts or UMA accounts. We also create a bunch of indexes that get licensed out for ETFs, and you can find those with our different ETF partners. And then we also have an online research platform. The one thing I'll say about that that's a little bit different from last call is we had a big release over the summer. We've changed the way a little bit that the research is delivered through our research hub. There's a lot more free content available if you're not already a subscriber. So I would encourage you to go to DorseyWright.com, look at what we have going on there. There's a lot of great information on there for both subscribers and non-subscribers alike. Now, looking at markets over the last 10 years or so, we have this quilt here that just shows kind of the different major equity classes and how they've performed over the last 10 years. And I think what becomes very clear is that theme of technology, large cap growth, mega cap growth, that has really been the dominant theme over the last 10 years. The Nasdaq 100 is represented by the Qs in this chart, has really outperformed the rest of these boxes by quite a large margin. Large cap growth is up there, kind of bringing up the rear are small caps, and surprisingly, developed markets and emerging markets over this longer time period. But we've seen that shift a little bit this year. So the growth, the large cap growth theme is still working, right? The Nasdaq 100 is still near the top of the list here. Growth is kind of at the more top end of the list. But also, we've had a big shift in international. So international has had a great year. We're seeing both emerging markets and developed markets perform really well. There's a number of reasons for that. You know, we've had a much weaker dollar so far this year. The tariffs and a lot of this other stuff has not affected companies in these international areas as much as it has affected the U.S. market. So that's been interesting to see. So this is kind of a bigger development that we're seeing this year. We haven't seen international really be leading for any prolonged period of time for a while. And so this is definitely something to watch out for, something that we're keeping an eye on. And we also look at different investor portfolios and allocations and things like that. And since we've had this kind of large cap growth technology theme going for so long, small caps and international have been out of favor for so long, it's probably a good idea to look through client portfolios. I think a lot of FAs are really kind of underweighted these areas just because they haven't performed as well. But now that they're starting to pick up steam, it's probably a good time to go in and look and make sure you have the proper allocations there. So that's been kind of a weird story with international so far this year. But on the domestic side, we'll bring Miles in to talk about kind of what we're seeing from a broad index standpoint, where we've been and where we might be going heading into Q4.
Thank you, John. Yeah, Dorsey Wright utilizes in kind of our research methodology what we call point and figure charting. Essentially, everything is rooted in supply and demand dynamics and ultimately price. Now, we won't get too far into the weeds, but it wouldn't be correct of us to not show at least the default chart for the S&P 500 and a couple of other relative strength charts worth mentioning. First, very broadly, the S&P 500 marching the new all-time highs. You don't have to be a chartist to know that all-time highs and a chart moving up and to the right is a good thing for us trend followers. And I like to look at it from a kind of near, intermediate, and long-term perspective. So we'll go through each one of them very quickly. In terms of our near-term picture, the S&P 500, again, our cap-weighted index here still trades at highs, as I just mentioned, in a column of X's as well. So that near-term picture is insulated here. We are a bit frothy around current levels, but again, when you're in a strong market environment, an overextended market isn't anything abnormal. The intermediate term picture, moving on from our near term picture, intermediate term picture, posting 3 consecutive buy signals off of those 2025 lows. Again, don't have to be a P&F expert to know that buy signals are a good thing. So again, intermediate term picture is sound. And talking about those 2025 lows, our long-term picture is still intact after a near test of that positive trend line back during that April exhale. You can see there we came down to that chart line, that kind of green arrow there, and ultimately bounced off of that trend line down below. So again, from a big picture, that kind of core cap-weighted market still doing very, very well so far in 2025. But moving on over, of course, we're all very familiar with the Magnificent Seven names. But ultimately, how are the other 493 doing, right? So how is the average S&P 500 stock doing so far this year? So over on the right-hand side, this is now the equal-weighted index, the equal-weighted S&P 500. That, we won't go through a near, intermediate, and long-term picture here, but we still trade at highs, we're still on a buy signal, and we still are in a positive trend. So ultimately, the longer-term technical picture is still sound here for the average stock, but we did see a little bit more chop throughout Q3 as those kind of core focus names really did dominate market leadership. Ultimately, what did that lead to? And now over on the right side of the page, we're comparing the two against each other. So this is a relative strength chart, now comparing the S&P 500 cap-weighted index versus the equal-weighted index. So when this value is rising, that means the kind of core cap-weighted S&P 500 is doing better. And that's exactly what we saw in Q3 2025. We actually moved and posted a 3rd consecutive buy signal on this chart and moved to levels relative price that we haven't seen since 2003. Now, for a lot of you on the call, you're going to say, well, you know, that was coming off the .com bubble. That's relatively pricey, right, that we're paying for that core exposure. But ultimately, right, as trend followers, we're going to expect this to continue until we see a kind of an opposite effect here. So point is that that kind of core dominated market is going to be really intact as we move into Q4 2025. Now, John, these outstanding leadership trends, they are typically tailwinds for momentum focused strategies. Why don't you kind of tell us what you're seeing on that side of things from the momentum standpoint?
Yeah, Miles. So you're right. When we get leadership that's intact, when it keeps going, that is generally a very good environment for momentum strategies. And this year so far has been decent for momentum. It really does depend whether you're kind of cap weighted more momentum or more equal weighted momentum. We'll kind of break that down a little bit later. But in terms of momentum, that kind of AI theme does remain in place. It has been good. A lot of the old leadership continues to perform well, so momentum continues to kind of chug along. It hasn't been as outstanding as it was last year, but still, considering the big momentum gains or outperformance from last year, it's been good so far this year. When we look at kind of how things are going on a longer term basis for momentum, we see that we kind of headed into 2024 with 3 years of underperformance of momentum. We don't get that a lot, but we've seen momentum bounce back pretty dramatically. And after 2 years of momentum outperformance, a lot of people are thinking, hey, you know, it's probably a little bit long in the tooth. Maybe, you know, momentum's due for some sort of reversal, something like that. But that's not necessarily the case. When we look at this this chart here, you can see that momentum will have multiple years of outperformance. We haven't really seen that slow down significantly. Like I said, that old leadership is still in place. And still continues to do well. So far in 2025, I think there's been 2 really big developments that have affected the overall momentum market and really disproportionately affected the very high end of the momentum market rather than, you know, kind of the more middle of the market. The first of those being that big DeepSeek announcement that we've all forgot about by now, but that was back in January of this year. That really hurt AI stocks across the board, and whether it be, you know, the stocks making the chips for AI, it went all the way down even into the quote, you know, stodgy utility companies that now are we see a lot of those that are much more growth oriented, that are really creating the energy to have this big AI build out that people are talking about. So that was the first one, really clipped momentum hard at the beginning of the year. And then the tariff announcement in early April was also really disproportionately affected the high end of the momentum market. Same kind of thing there. But with that, momentum continues to hang in there, continues to do well this year. And it looks like we might have good, you know, kind of a good momentum market heading into the end of the year. The fourth quarter of the year is typically a strong one for momentum. It's seasonally that over time, that tends to be the strongest quarter of the year. Now, some of that is just due to the calendar effects and how tax selling works, right? Typically, momentum stocks have larger embedded gains. They're up a lot rather than beaten down. Investors, generally speaking, don't want to sell those things until the new year to delay the tax gains on those, you know, another 12 months. So that's kind of the underpinnings of why Q4 tends to be very good for momentum. There's some other reasons, but that's a big one. And you see Q1 isn't great. That's the second worst. And again, you know, that's kind of that January effect, and a lot of momentum studies will kind of pull out that January effect when they're looking at that as kind of investors that have delayed gains go ahead and sell those as soon as the new year comes. Now, a couple other things to watch in terms of momentum is the outperformance by the mega cap space versus, quote, the average stock, right? So this chart here shows the rolling 3-year excess returns of OEX, which is a, you know, very large cap index, versus the S&P equal weight, which is just the S&P 500 stocks, but all equally weighted instead of cap weighted. So you can see this capitalization dominated performance here. It's gone on a while, but we're nowhere near what we saw at you know, at the end of the 90s with the big tech bubble, things like that. So this could keep going. Now, look, when that finally burst and that finally kind of rolled back, we saw, you know, a number of years of outperformance by equal weight versus the cap weight. So always kind of keep that in mind. What we've got in place now is this capitalization dominated market, but when that shifts, we can also have multiple years. So it's important to kind of remain flexible and have an investment process where you can kind of shift around to different areas. Now, we've seen that really reflected in the concentration at the top end of a lot of these cap weighted indexes. So as of the end of 2022, the top names in the index were about 25.5% of the index. Fast forward that to the end of September, and we are looking at over 40% today. So the market has become much more concentrated in these mega cap names, and that's what's really driving this outperformance of cap weighted versus small cap or equal weighted that we're seeing. Now, when we break it out by momentum quintile, and this is the domestic side, this is mid and large cap stocks, and this is kind of an equal weighted look at momentum. So the laggards, which is that bar on the right that says BOT, the laggards have performed worse, which is good to see. We want the laggards to be lagging. That's a great thing for momentum. And that top end of momentum is hanging in very well. It's not doing as well as some of the other areas, but it is showing good performance. So from a leader lagger standpoint, it has been very good. On the emerging market side, the laggards have actually performed very well this year. A lot of that came at the beginning of the year when that laggard bounce was still kind of sorting itself out. But the top end of momentum in emerging markets has also performed very well. That has picked up over the last 3-4 months, I'd say, and emerging markets in terms of momentum strategies have really begun to come to the top of the list and really started to perform much better. They had been lagging behind developed and domestic markets, but we're seeing much better indicators there. And finally, on the developed market side, this is where we've seen the best momentum indicators for quite some time. This is a very good look at what you want to see in terms of quintile performance. The top quintile's outperforming everything else. The laggards aren't doing great. And from a momentum indicator standpoint, developed markets continue to be a really good place to look at momentum strategies. But when we're looking at international, and we'll bring Miles back to talk a little bit about different countries, we're talking here about individual stocks and this, that, and the other. But there are definitely some country strategies that you can use and overweight certain areas. And we do have a bunch of great tools on the Dorsey Wright site to allow you to do that very easily.
Yeah, thanks, John. As internationals continue to do quite well, I'm sure a lot of you are getting more questions about where you need to be positioned on the international front. For the Dorsey Wright perspective, we can utilize what we call a relative strength matrix, which essentially pits different representatives from anywhere. In this case, we're going to look at an international matrix, but you could pit together different broad asset groups, different stocks, whatever it may be. But in this case, we can use, again, that relative strength matrix to look around the globe to see what spots specifically you need to be focusing on. We've included the top half of our rankings. We look at 41 different countries in that matrix. We've included that over on the right side of the page. You all can kind of poke through that as you will. But what's most interesting is perhaps the composition of that top half. So we can look kind of x-ray through and say, okay, hey, on the developed front, where are we seeing a lot of strength? That's going to be within Europe. Specifically also within Europe, the emerging front as well. So Europe has been a point of strength. That's been a kind of a tailwind here for strategies and international strategies around the globe, much less so on both the Americas and Asia Pacific group. Sans one, which would be a kind of rumble or continuation of strong movement for China here, which has moved kind of into the top half of our ranks. That has also, as John mentioned before, contributed a lot to that laggard rally that we saw, specifically from the emerging market space, with China improving quite notably over the third quarter. When we actually look at where that strength has moved from, though, we have seen a near-term kind of change or small rotation out of the developed front more towards the emerging front. That's that bottom table in terms of the Q3 total rank movement, and more towards the kind of Asia-Pacific group there as well. But again, real story there is away from developed and towards emerging, but there's still a large concentration of the space in developed that looks quite good as well. To further this idea, we can utilize Dorsey Wright's fund scores to compare different assets. So the fund scores, if you're unfamiliar, range from 0 being the worst to 6 being the best, and they aim to give you a general idea of how well a specific fund is doing. Now, the bottom portion there, we've taking a look at two different representatives, EEM on the emerging front and EFA on the developed front. We look at typically a score of 3.0 as average or acceptable from a technical standpoint. Emerging markets near perfect. Again, that's largely in part due to that rally from China and emerging markets in general. But developed markets falling off slightly, but still acceptable. So certainly, again, both of them are present technical and kind of favorable technical pictures. We're certainly very interested to see how momentum continues as we move into the fourth quarter of 2025. Next, we can talk about a general area of weakness because it's still important to go out and find areas of relative strength within fixed income, right? Although we've seen much more of a kind of risk-on preference, equity focus throughout 2025, a lot of us still need fixed income exposure. So we can utilize relative strength to figure out where specifically we need to be on that front. So on the left side of the page, we've taken fixed income and divided into a bunch of different subgroups that you could look towards. From there, we can then focus on kind of what areas are doing well, average, and perhaps points of weakness as well, the ones that we want to avoid. In terms of those points of strength, risk-on areas are doing quite well. So equity-focused convertibles doing well alongside the equity space. International equities, as we kind of touched on throughout the call today, international equities also doing well. But in general, it's more of a risk-on flavor towards the top. Next, generally, fixed income is kind of towards that average to weak side of our rankings here. Rates have fallen. That's been kind of a tailwind for the group. But in general, kind of that all fixed income group towards the bottom middle of the pack. And lastly, points of weakness, risk off areas, U.S. government, municipals, long duration has been a point of weakness that's moved up recently. So we'll be interested in kind of continuing to see where that goes as the rate environment shifts. But again, that is where you can utilize relative strength when you're looking for specific asset groups. Where do I need to be? Even though fixed income is generally weak, where can I actually go to find those points of strength? And we'll wrap up the kind of the fixed income commentary with just one comment on rate cuts around specifically all-time highs. So we looked back at a handful of different instances through history, kind of asking the question, what do markets typically do when we cut rates while the market is around all-time highs? That's that table here on the screen. Really the main takeaway is over the next year, things are actually positive more often than not. Actually, every time there hasn't been a negative instance, knock on wood. But on average, you're up around 12.5% over the next year. But the path that you take to get there is a little bit choppy. So the 30-day performance and 6-month performance, you're slightly below your long-term averages. So as we enter the final quarter of 2025 and open up 2026, we could see a little bit of chop if history has anything to say about it. But point is that most of the time these rate cuts aren't headwinds around all-time highs for equity markets. John, why don't you come back on real quick and just kind of touch on the general rankings as we move into the year, what you're seeing as points of strength on the equity and commodity space as well.
Yeah, thanks, Miles. So this is our Dolly tool, dynamic asset level investing. It is just a ranking of the different major asset classes and really where we want you to overweight, where we want you to underweight. So you can see domestic equities continues to be at the top of the list, but that spread between domestic and international has really narrowed over the past year. For many years before 2025, domestic equity was really, the tallies were really a lot higher than some of the other areas. So on the equity side, domestic and international are both kind of overweights there. You can see the commodity group right in the middle. A lot of that is the precious metals area, gold, silver. That has done extremely well. And then fixed income down at the bottom just does not continue to perform as well as some of the other asset classes. That has been the case for a long time. So those things you see in green are areas we want you to focus on and overweight, and the stuff in red are the areas where we would look to underweight. We know that you have to have maybe some allocation to some of these areas, but kind of looking at it like overweight, underweight is really the best way to look at this overall model. So we'd like to bring on the first speaker, Phil, who is our chief economist at Nasdaq. He always has a lot of great economic information, a lot of interesting stuff. So we'll turn this call over to Phil now, who's got a lot of charts, a lot of data, and I think he's got all the answers to what's going on. So it's going to be great.
Yeah, we wish. Thanks, John and Miles. Just in case people are getting a bit sick of tariffs, I thought today maybe we'd focus on everything else almost. But it's kind of hard to not talk about tariffs at all. So let's just quickly run through what's going on with tariffs right now. The reality is they're pretty big. You can see this is real tariff revenue. It's accumulating at about $30 billion a month, quite a lot of extra revenue compared to the baseline coming into the Trump tariff war. And also a lot of the tariffs are in this blue zone, which is rest of the world. So it's not just China that's hurting, it's a lot of other countries with those higher tariff rates that are starting to see the impact of tariffs, at least on their imports now. But the reason the data is still kind of choppy is we saw a lot of companies actually accelerate their imports before the tariffs were announced. We saw the trade deficit here double, and then with the tariffs being delayed, we saw 3 months of those accelerated imports. So it's a little unclear how many imports made it into factories, how many are still to be sold. When you're looking at the actual price increases that are coming through, is it companies preempting having to import tariffed goods, or is it really passing through the actual tariff costs? It's really unclear. And also from a GDP perspective, when you think about how you would say GDP is good, increasing exports is a good. So obviously increasing imports is an opposite to that, so it's a bad. It explains why we had a negative GDP in Q2, and it also explains why we've had the bounce back with a really strong GDP in Q3. Even the GDP numbers are a little bit hard to interpret right now. I think the other thing, especially for companies, but even for investors to keep in mind, is the US economy these days is about 80% services. And of the goods sector, only about half of the goods are imports. So even if tariffs are 10, 15%, it's 10, 15% on 10% of our GDP. It's not a massive hit to inflation mathematically, and it's not going to affect every single thing that we spend money on. So just something to keep in mind. All right, so let's talk about some of the other economic data. And the reality is, and what I want to do today is sort of move away from looking at averages and start to break things down, because it does show some interesting trends. And the reality is, if we look at the factors that drive GDP, or at least the factors that drive whether we're having a recession or not, it's whether real GDP is increasing. And we talked about the drop and the recovery, but GDP is still going up. Industrial output had a flat zone, but despite the tariffs and probably really a bit before the tariffs anyway, it had started to recover. Non-farm jobs had been accelerating really quickly. They're slowing down now, which is actually a good thing for companies. I'll talk about that in a minute. But this strength in the jobs market sort of translated into higher wages, which translated into higher personal income on the top right chart there. And that higher personal income, if we look at the next two charts below it, translated into consumer spending strength, business sales that are starting to pick up. So no sign of recession in this data, no sign of tariffs at the very endpoints of the data either, if you really think about it. If we look at this chart, this is services and manufacturing PMIs. So PMIs are surveys of companies, how they feel about forward orders and employment in the future and maybe investment in the future, things like that. The green is the services sector. And so you can see both the red and the green have been falling from that post-COVID high. And where they've been lately is relatively weak, definitely weak compared to that like 2000 teens period. The manufacturing sector, if you talk to people, they feel like they're in recession. Although the industrial production, which is the gray line there, like we talked about before, it was growing slowly and it started to pick up. So maybe manufacturers feel like they're worse than they have been. The important thing is services, like we just said, 80% of the economy. So the fact that it's positive is enough to keep us out of recession as well. That's where the spending really is. I thought this chart was interesting because it breaks out the GDP growth and looks at all of the tech spending. And a lot of the tech spending is happening in chip fabs, construction of the chip fabs, actual chip imports. So there's a lot of spending happening that's driving GDP in that AI space, which Miles and John alluded to. This chart basically seems to indicate if we weren't spending what we're spending on AI, maybe we would actually be closer to recession in terms of our GDP growth. So the AI spending is definitely material and a big part of the growth story in the economy. If we look at the labor markets, the reality is the labor markets have been softening for years. You can see that in the green line here. At the peak levels as we came out of COVID, a lot of people didn't want to come back to work, but a lot of companies needed workers again. We had 2 jobs for every 1 person looking. That's completely fallen back down below those pre-COVID levels now. The good thing about that is it's made wage growth slow. But I think the other thing that's worth noting is the layoffs, which is the red line here, is still really low. And so although we haven't got strong hiring, we also haven't had too much firing. And I think that's kept the consumer confident. And that's been really important, I think, for the economy because the economy has been consumer driven. But again, nothing to show for tariffs, which would be the last 3 or 4 data points in here. Talking about the wage growth, so the blue line here is quits, which we just talked about. Like people aren't actually leaving jobs because the market has softened. There isn't that many jobs to move to. And the good thing for companies, that's an indicator, if you look at the black line, of wage growth slowing. And so that's helpful for companies because wages were, if we looked at some of the surveys 6 months ago, one of the big problems companies were dealing with just in terms of growing profitability, especially in the small cap space. Looking at unemployment, obviously the Fed has restarted rate cuts and all the talk was about the revisions to the numbers and how suddenly the employment market got worse. But in reality, I think this chart sort of shows the unemployment rate, which is the orange, has been kind of grinding slowly higher for a number of years. And the continuing claims, which is basically showing that people that have lost their job are taking longer to find jobs as well, has been going up pretty consistently too, but since 2023. So again, not much of this shows any sign of tariffs, but the labor market has just been slowing down for years. One of the interesting questions about the labor market is this AI taking the jobs? And I think there's a few different theories. One of the theories that says it is relies on data like this chart, where you're looking at graduates, so really young people entering the workforce, but with degrees. So they may normally come in and do things like programming jobs, or office jobs that AI might actually be able to replace. And you can see that the unemployment rate of them as a whole has started to increase. They've taken longer to get jobs. But when you break it down by male and female, you see that the unemployment rate for males is going up and the unemployment rate for females is going down. And a lot of people look at this and say, well, actually, if you think about what women, like the industries that more women work in, it's often education and health services, which has been one of the strongest for job gains this year. And a sector that a lot of the males might be going into, the degree qualified males, is the information technology sector, which is one of the sectors that's actually shrinking just a little bit. And so maybe the data does support that AI is starting to have an impact on the labor market, or maybe not. So this chart here I thought was really interesting. It's ranking jobs by how AI exposed they are. And so the light green line is the really heavily exposed to AI jobs. And you can see not only is it not moved, but it's also right at the bottom. So the most AI exposed industries right now still look like they're hiring people to try and deploy the AI, not firing people because AI is doing people's jobs for them. If we sort of pivot and think about the consumer, because obviously the consumer has been driving the economy for the last couple of years, there's a few signs of weakness. So if we look at this chart here, this is looking at spending and it's positive. So it's been growing, but you can see if we break it down into lower income consumers, which is the red line, and higher income consumers, which is the blue line, they're starting to see differences in their spending behavior. The lower income consumer looks like they're starting to struggle a little bit more with their budgets. The higher income consumers are making up more and more. The top 10% of households now spending almost 50% of the retail spending, and that's been increasing. One of the reasons for that, or at least something that's not going to help it reverse, is what's been happening with wages. So we talked before about how as we came out of COVID, there was a lot of jobs and not many people wanting to work. That was actually a really good thing for low-income workers. So the red line on the left-hand side of this chart, the low-income workers saw their wages grow faster than inflation for a while as we kind of came out of COVID. And that started to change. And what we've had now is the higher income people who didn't see wage gains early on are now actually starting to catch up and see their wages growing faster than the lower income people, which obviously won't help with the spending that we just saw in the chart before. Something else that won't help with the spending that we saw in the chart before is what's going to happen from the big beautiful bill. So obviously, if we look at all consumers on the very left-hand side, it's net positive. There's tax cuts, there's fiscal stimulus coming through next year in the fiscal package. But if we look at it broken down by income group, you can see the beneficiaries are more on the right-hand side. So again, that's higher income people are likely to benefit more from the tax cuts than low-income people as we head into next year. So some differences starting to work their way through the underlying economy, depending what company you're in. Because everything's softening, though, we are, like we said, starting to see rates come down at last. And I say at last because if we think about what was happening in 2024, almost all the big central banks were cutting rates, and then the US was a bit different than everyone else, and it hit pause as soon as the tariff war started. You can see that the UK central bank, the European central bank, even Canada kept cutting rates, and they are all now much lower than us and much closer to their inflation rate, so a very low R-star type neutral rate. We have now started cutting, and what's interesting is looking at the lighter blue line to the right, the forward curve. We're pricing in basically 2 more cuts this year, 3 more cuts next year. That's changed a lot, and it's changed really quickly as those softer labor data has come in. But it's good news for companies because a 3 to 3.5% interest rate is going to be a lot more affordable on their debt than something in the sort of 4.5% rate. It's also good news for consumers. If we look at delinquency rates, one of the things you see here is the light green and the black are starting to increase, and these are revolving debt. So credit cards, car loans, things that people have had to take out more recently that are going to be affected by interest rates going up and have more recent payments. What's interesting is home loans, you can see the delinquencies at the bottom there have hardly changed. And so I think that's one reason why monetary policy didn't really work this cycle. A lot of people, if we look at what's happened with home loans, you can see that the blue arrow here shows a lot of people refinanced into sub 3% mortgages. Many of them came out of 4 to 5% mortgages, which is the green arrow. So a lot of people still have mortgages under 3%. That means that they locked them in for long term, 30 years. They haven't had any changes to their mortgage rate because of the Fed's interest policy, but it also is affecting the housing market because they can't afford to move with the mortgage rate sort of close to 6 or 7%. You know, basically you do the math in your head. It's like half the size house, you're still paying higher mortgage if you have to get a new mortgage from 3 to 6.7%. And so we are still seeing a lot of weakness in building permits in the household sector. It almost looks like people may be stuck in their houses if they own one, which means everybody coming in to the market is kind of forced to rent, and that's holding up some of the inflation data because rent is a big component of inflation as well. The lower interest rates are also going to be good for the small cap space. So I know John was talking a little bit about the equal weighted index, which obviously would overweight the small cap companies. Small cap companies, if we look at the green line here, have seen almost half of their earnings before interest and tax being absorbed by the interest expense as the rates have gone up. They've been much more exposed to the Fed hiking rates than that orange line, which is large cap. And obviously that's really making it hard for them to return to profitability. But the good news is if we look at profitability, the blue bars in this chart show that large cap earnings growth story, the AI spend story, why those stocks have been outperforming other stocks, whether it's international stocks and small cap stocks in the sort of 2023-24 period. The good news is analysts are expecting, if we look at the green lines or the green bars, the small cap earnings to start to recover and catch up and maybe even exceed some of the growth rates of the large cap space. And we saw a pretty decent starting point with Q2 earnings this year as well. So it looks like small cap is starting to benefit from lower rates, from lower wage increases, and from continued consumer spending. The last chart I was going to look at is this one. Given we were just talking about earnings and how important earnings recovery might be for small cap, this is looking at whether the market is going up because of earnings recovery or because of multiples, where interest rates coming down might drive multiples up. And it kind of looks like, I guess we're almost 50-50, but relatively, we are an earnings-driven market lately, which again explains the AI thread, but it also could be good for the small cap space if their earnings really do continue to follow through and recover, and the consumer doesn't hurt that outcome. So I can turn over to Yanni.
Great. Thanks, Phil, for that really helpful backdrop and setting the table, and then also to John and Miles, because it's really nice when the fundamentals sync up with the technicals. So starting off here, I think it's always healthy and informative to take a step back and look at the performance on a year-to-date basis thus far. And a lot of this is going to mirror what John and Miles have been seeing. But as they noted, one of the larger underperformers for the year, and on this chart, the largest, is the dollar index, right? And down by around 10% on a year-to-date basis, which is the weakest return since 1986, which followed the Plaza Accord in 1985 and the coordinated weakening of the dollar. Now, because of that dollar weakness, you have seen the dollar weakness beneficiaries really stand out this year, and namely gold. It's had its highest return on a year-to-date basis through 3 quarters since 1979 in the hyperinflation era. And then I'd also note, as John and Miles talked about too, was EM equities, right? Really strong here, best year-to-date through 3 quarters since 2017, given the tailwind from the weaker dollar. And then this has, of course, helped international equities as well too. And I'd also note Bitcoin as a weak dollar play and also a diversifier, particularly as you have had elevated bond and stock return correlations, which I'll get to in a little bit. Now, it's not to say that U.S. equities haven't done well, right? It's been very, very solid. When we look at Nasdaq 100, U.S. large cap growth, S&P 500, all very solid mid-teen returns on a year-to-date basis. It's just that they're in the middle of the pack here. Now, maybe shifting over to the right-hand side and looking at things more in a micro perspective. Of course, the AI secular theme has been driving the year-to-date rally. Nothing we don't know, led by communication services and infotech and Mag 7 up there as well too, as a representation of the mega cap tech names. I'd also note infotech is a weaker dollar beneficiary. Over 50% of the tech sector's revenues come from outside of the US, so the weaker dollar certainly is helping from an earnings perspective there. Now, I think what's really healthy for the US markets too is seeing the likes of industrials, utilities, and financials performing strongly as well, right? And just some comments on each. First, with industrials, they've been benefiting from the Trump administration's reshoring and manufacturing agenda, also from defense spending, and also part of the AI infrastructure build out. Utilities, again, this is seemingly acting more as a cyclical versus more of a defensive bond proxy, right, which is its kind of traditional role. And this is just given the sheer energy required to power AI and the large language models and such. And just as an example, which is kind of a mind-blowing stat, if you look at the 4 AI hyperscalers with Amazon, Google, Meta, and Microsoft, their CapEx is slated to be around $400 billion in 2026. And that equates to a nominal GDP of 1.4%, right? So 1.4% of nominal GDP coming in terms of CapEx spending plans from these 4 hyperscalers, which goes into and speaks to that chart that Phil had thrown up in terms of the strong support coming from AI and the build out there. Financials, finally here, I'd note that they have been actually outperforming the S&P 500 for the better part of this year. It's just over the recently they've kind of given that back. But financials have done well in terms of expectations of increased M&A activity, the steeper yield curve helping banks, and then also deregulation and what has really been a relatively resilient U.S. economy, which helps with a lending activity from a banking perspective. Now, those were the kind of the micro tailwinds, right, for equity drivers on a year-to-date basis. If looking at a couple of select top-down macro tailwinds, I want to point out here. On the left-hand side, we're looking at ISM manufacturing. And as Phil had noted, right, 80% of the U.S. economy is services-oriented. I appreciate that. But looking at ISM manufacturing here, because relative to the ISM services sentiment, it has a longer history. It goes back to right around World War II. It's less volatile than the services PMI, and it also ebbs and flows really well with the U.S. business cycle. So just context as to why I'm picking that here. And this is looking at it at a year-over-year basis in the blue bars. And we saw a sharp leg down, of course, around the April and May timeframe, given the peak tariff concerns. But since then, business sentiment overall has stabilized, right, as we've kind of moved past those peak tariff concerns. Still an issue, but not what it was 6 months ago or so. And in tandem, you've, of course, seen S&P 500 here in green rebound on a year-over-year basis. But I think more importantly, cyclicals outperforming defensives in purple on a year-over-year basis. So you've had this business sentiment kind of stabilize and then also help with the bounce back in U.S. equities on a year-over-year basis. Now, moving over to the right-hand chart here, I think a key ingredient for investors is being able to have an understanding of what the financial conditions backdrop looks like in order to add or to reduce risk. And here in green, if we're looking at a proxy for the Bloomberg U.S. Financials Condition Index, this is a combination of money market fund, fixed income, and equity indicators. I won't get into what makes them up. It's in the fine print there. But this is on a Z-score and a standard deviation basis. So basically over 0 on the left-hand side there equals looser financial conditions. Below is more restrictive. And again, you can really see the gap down there in terms of certain parts of the market seizing up around that April timeframe. But then we've moved more into a more accommodative financial condition backdrop, which has helped underpin risk over the past 6 months. And as we're staying in there, I think that's a key ingredient for a risk-on backdrop. Now, of course, you've seen large cap outperform small cap. Nothing new here. This is indexed to 100 going back 3 years. But I think the interesting point is that Russell 2000 has really rebounded strongly, particularly as you've had the cost of capital coming down. So around 40% of Russell 2000 index has variable rate debt as compared to around less than 10% for the S&P 500. So lower cost of capital factors into a healthier earnings backdrop for the smaller companies, which have outperformed by a lot over the past several years. So I think an increased area of interest for investors here. Now, in terms of the financial conditions, right, being more accommodative, another key component of this, of course, is the market's pricing in the Fed cutting rates as Phil went through. And on the left-hand side here, we're seeing the Treasury 2-year yield, right, which is the more Fed interest rate sensitive part of the yield curve relative to the Fed funds rate. And as you can see over the past 25 years, this has followed in tandem very nicely with one another. A couple interesting points. One, Morgan Stanley notes that the 2-year Treasury yield tends to have a 20-week lead versus the Fed funds rate. So here the markets are telling us that the Fed still has room to cut and expects the Fed to actually catch down with market expectations. And then also number two, when you see this delta, when you see the spread between 2-year Treasury yields less the Fed funds rate hit minus 100 basis points, which is right where we were around Fed rate cut day on September 17th. These periods tend to take place really only around the recessionary timeframes. Again, by no means, I don't think we're going to recession, completely agree and defer to Phil on that. But the point is the market is telling us that there is still more dry powder for the Fed to cut, particularly if we think that the neutral rate is caught in the 3.25% percentage area, right? And this, I think, leads to the tailwinds for equities. And on the right-hand side, you see that during a falling Fed rate regime, right? On average, you see the average monthly return for the S&P 500 at 1.7%. So again, just another example of more accommodative financial conditions helping with risk assets. Now, there's been a lot of talk, of course, around elevated valuations, and we can't go through a fundamental presentation without hitting on those. So at the end of the day, any way we kind of cut it, regardless of the valuation metric, U.S. equities are expensive on an absolute basis relative to themselves, relative to other parts of the market cap structure and also the international equities as well. Here on the left-hand side, you see Nasdaq 100 and S&P 500 next 12-month PEs relative to their 20-year history in the 95th percentile, right? So certainly expensive on these measures, and you could see even more expensive when you compare it to the mid-cap, small-cap, and international space, which again, on a relative valuation perspective, I think there are interesting opportunities here given the relative valuation discounts and differentials. Now, a couple of notes. One, valuations historically are not a good timing indicator for the short term. So something to keep in mind. Over the longer term for fundamental analysis, it certainly matters. But over the short term, it's not a good timing tool. So just because we're saying something expensive does not mean that in the short term, it's going to go the other way, right? And that speaks to the momentum, which Miles and John had spoken about. But more importantly, from a fundamental perspective, it speaks to the earnings growth and the earnings trajectory. And at the end of the day, investors are willing to pay these prices because the U.S. earnings complex is solid. And on the right-hand side, one example, which I've shown before, is the S&P 500 earnings revisions breadth from Morgan Stanley. And this basically shows the number of positive analyst revisions minus the number of negative ones divided by the total amount, which gives us a diffusion index on the right-hand side. And we went from minus 25% during the April-May peak tariff trade uncertainty time frame to now 20%. And you can see on a year-over-year basis how this tracks very well with S&P 500. So as long as we're having these positive earnings revisions continuing to come through, it can justify and support these elevated valuations. Because again, elevated valuations are not new for the U.S. equity market, right? We've seen this over the past 3 or 4 years, very elevated valuations, but we still have had strong returns. So you can't hang your hat on just that metric alone. And then I think breaking down the S&P 500 into the Mag 7 and S&P 493 is interesting as well too. So you look at the Mag 7, 30 times forward PE, which is certainly rich and expensive, but a couple points. One, if you actually look at this over the past few years, it's still right at the midpoint. So relative to its recent history, it's in line. And number two, given the fact that these are best-in-class companies, large moats, the sheer amount that they're investing in AI, which investors are hoping are just going to pay off, this has just boosted their EPS growth rates, which admittedly are lofty. And the question for investors is, can they continue at this clip? But for the time being, if you figure over the past 6 quarters, it was around a 30+% EPS growth rate. And you tell me that their valuation is 30x, right? 30x, 30% year-over-year EPS growth rate. You could argue that they've been fairly valued. I think the more interesting place to watch for investors is going to be the remainder, right? The 493. 20x here on the left-hand side, certainly higher from the 13, 14, but cheaper than the overall market, of course, right? Which has been driven by the Mag 7. And more importantly, from a fundamental bottoms-up perspective, look at the right-hand side here. Looking at 2026, bottoms-up consensus is now forecasting low to mid double digits in terms of EPS growth rates for the remaining 493, which gets back to the earlier comment of seeing industrials, utilities, financials performing well. So that's where investors are continuing to sharpen their pencils. And finally, 2 things just to watch in terms from a trending perspective, right? VIX on the left-hand side, equity volatility remains low, right? This is more of a coincidental indicator, but the markets are telling us that things are behaved. I think for more of a leading indicator, important to watch U.S. high yield spreads, right? This is another indicator that the U.S. corporate market is relatively healthy, but something to keep an eye on. Finally, on the right-hand side here, a lot of noise, but I'll focus on the blue line. This is the 30-day correlation between 10-year bond return, treasury returns, and also daily returns in the Nasdaq 100. And this hit 50% around Fed Day on September 17th. So that elevated level of stock bond return correlations really can make it difficult for investors to look for diversification. And that's where we get into those earlier charts, which show the likes of gold and which show the likes of Bitcoin as well, which investors have been going to for a diversifier in this backdrop. So with that, let me turn it back to John, who I think will take us through some Q&A.
Thanks a lot, Yanni and Phil. That was really great information. And I think we've really kind of hit the market from a number of different standpoints: technical, economic, fundamental. I think all those three pillars are really important to assessing what is really going on in the market and how we think things are going to shape up heading into Q4 and into 2026. And we had a couple questions. Speaking of 2026, I'll bring Miles in for this one. And we got a question just about the strength in international equities, emerging markets especially. Now, does that mean like if international is going to be strong, does that mean that domestic automatically has to falter so that international can do well?
No, everyone can join the party, right? No, I mean, you see specific areas, right, of the globe do particularly well. But again, we want to emphasize, just because one spot of the market is relatively hot, that does not mean that that other areas have to kind of cool off, right? There can be a spread between those two assets, right? But if one is up 30, something else is up, 15, both of them are having productive years. Where momentum can take advantage of two strong assets is finding the one that's relatively better. So to answer that question, no, we do not have to see, international equities do well, domestic equities fall, just so there's room. And momentum can still, I think the most important there is momentum can still have a productive environment between two strong assets or between two above average assets by capturing that spread between the two.
Great, thanks, Miles. And I had we got a question for Yanni, which I think is interesting. You mentioned, and I think we've all heard that valuations are not a great short-term timing tool. But when we look at these different PE ratios, for example, of the different areas of the stock market, like in your experience, what kind of time horizon does that really shake out in? Is that a year, 5 years? Like how long does that stuff generally take to materialize?
Yeah, it's a great question, and there have been a lot of studies on this. If you look at kind of from a historical perspective, if you look at the forward returns and the correlation relative to current present day PEs, it's really more of like a 3 to 5 year, right, where that correlation starts to move higher. In the short term, kind of over a year out or so, it's really it's not a strong correlation. So that's kind of like the short term versus more of the medium term.
Great, thanks. And finally, a question for Phil, and this is one that's probably difficult to answer, but we've got the government shutdown going now, right? So that means that we could have limited data coming out. Like, how is that going to affect a lot of these models? Obviously, the longer this drags on, I would assume the more it does. But we've had shutdowns before. In your experience, has this really made a difference in terms of getting the data that we need for this stuff, or is it just kind of a non-event?
I mean, let's talk quickly about what happens to the stock market too, because it's interesting. Over time, in the old days when we had shutdowns, the market would sell off, but it seems like the more modern shutdowns, the market's actually been fine to deal with the shutdowns, and that probably helps us think about what's going to happen with the data. And I think again, these days, there is so much private data. There is so much alternate data. There's so many professionals able to extrapolate and interpolate from other data points what's basically going on, that I think we will be okay with data, as well as probably okay with the market. A lot of people are talking about the fact that even the salary that doesn't get paid for the next week or month or however long the shutdown lasts is also going to get paid back in arrears too. So the short-term impact on GDP as people maybe tighten their belts if they work for the government and they've been furloughed unwinds as well. So I think that's important to remember from a GDP perspective. So lots of different, I guess, things to think about, but I don't think the shutdowns, and the market doesn't seem to think the shutdowns are as scary as they sound in the press.
Great. Thanks a lot, Phil. I think this has been a great overview of the market. Miles, Yanni, Phil, thank you guys so much for taking the time to be on the call today. Remember, if you're listening live, please take that survey at the end. That feedback is tremendously important to us. And if you're listening to this on replay, there'll just be a short quiz to take for your CE credit. So thank you, everybody, for joining today. We're planning on doing this again next quarter, so be on the lookout for that. And everyone have a great rest of your day.